Welcome to Statement of Cash Flows, Introduction. By the end of this ACLET, you should be able to explain in general terms what the purpose of a statement of cash flows is. You should also be able to determine which of three categories a particular cash flow belongs in using the direct method. By the time you're using this ACLET, you should already be well acquainted with the first three financial statements: the income statement, statement of retained earnings, and the balance sheet. These three financial statements have been around for hundreds of years, but the fourth statement, the statement of cash flows, has only been around since 1987, when FASB, the Financial Accounting Standards Board in the U.S., added it to the list of statements required for audited companies. FASB designed the new statement to fill in a gap created by accrual accounting. Remember the revenue recognition and matching principles? Record revenues and expenses when we incur them, regardless of when the cash changes hands. Since the income statement, statement of retained earnings, and balance sheet are all prepared in accordance with these principles, it's sometimes difficult for the reader of the financial statements to see what actually happened to a company's cash during the accounting period. So that's what the statement of cash flows is designed to do: show the reader what actually happened to the company's cash during the accounting period. Designing a statement that would show every penny of cash that came in and went out of a company during an accounting period was a challenge, which is why the statement's only been around for a few decades as opposed to centuries. The cash flows would have to be organized into categories, but how many, and exactly which cash flows would belong in which category? After much debate, deliberation, and discussion, FASB settled on three categories of cash flows. Every penny of cash that came or went during an accounting period for a company must be reported in one of three categories or sections in the statement of cash flows. FASB approved somewhat reluctantly two approaches to presenting the statement of cash flows: the direct and indirect methods. We will use the method that FASB recommends, the direct method. The first category is cash flows from operating activities, but this turns out to be the messiest of the three, so we'll save it for last. The second category is cash flows from investing activities. This is where we'll list cash receipts and payments related to non-current assets. What is the time period that we use to distinguish current from non-current? Generally 12 months or 1 year. So cash received from the sale of assets that we used for more than 1 year, or cash paid for assets that we plan to use for more than 1 year, will be listed in the investing activity section. Examples include cash received from sale of equipment, cash paid for land, cash received from sale of long-term investment, cash received from sale of patent, and cash paid for vehicle. The third category is cash flows from financing activities. This is where we'll list cash receipts and payments related to long and short-term borrowing, and cash received from and paid to our own stockholders. FASB recognized that a company can obtain financing from two sources, lenders or owners, so they combine these cash flows into the financing activity section. Examples include cash received from issuing bonds, cash paid to pay off a short-term note payable, cash paid for dividends. This cash goes to our own stockholders, right? Cash paid to purchase treasury stock. Again, the cash is going to our own stockholders. And cash received from issuing shares of common stock. Now back to the first category, cash flows from operating activities. This is the catch-all or default section, meaning that if some cash received or paid does not fit into either of the other two categories, it ends up here. But more specifically, cash receipts and payments related to operations will be listed here. Examples include cash received from customers, cash paid for merchandise inventory, cash paid for payroll, cash paid for utilities, cash paid for property taxes, cash paid for insurance, cash paid for income taxes. Then we need to talk about three special cash flows that FASB struggled with because each of these three could logically be listed in either two sections, so FASB had to choose which section. The three special cash flows are cash received for interest, cash received for dividends, and cash paid for interest. If we receive interest and dividends from long-term investments in other companies, stocks and bonds, you could argue that the cash received should be listed in the investing activity section. And interest paid would have to do with short or long-term borrowings, so you could argue that cash paid for interest should be listed in the financing activities section. FASB acknowledged these arguments, but FASB also wanted the statement of cash flows to show as clearly as possible the differences between accrual and cash basis accounting. The most effective way to do this was to bring cash flows from operating activities as close to net income as possible. Since interest revenue, dividend revenue, and interest expense are all included in net income, FASB decided that the cash flows associated with these items should be listed in the operating activity section. Why is cash paid for dividends not included here? Because when a company pays dividends, the cash goes to its own stockholders, which makes this a financing activity item. And these dividends paid are never included in net income. They are reported on the statement of retained earnings. So there's the why, but it might be simplest to just memorize these three special items and the fact that they will be included in the operating activities section. This concludes the ACLET Statement of Cash Flows Introduction.